Jim, you're up.
Good afternoon, everyone. My name is Kim, and I will be your host and administrator today. I'd like to take this opportunity to welcome you to the Abernathy Group Family Offices February 2025 First Friday meeting. Today's presentation is titled Intelligent Investment Themes for 2025. In our First Friday meeting today, as always, we will focus our discussion on the opportunities and risks available today from an investment themes focused approach. As discussed in previous family office meetings, our emphasis will be to focus on intelligent investment tactics that will allow investors to remain invested while controlling investment risks for our family office members who want to make sure they don't have to go back to work again and make it all over again. As you can see from the start of the year so far, 2025 promises to be challenging as most public markets are priced for perfection. Speculation is abundant, and policy is changing rapidly. Today, our prepared comments will be recorded as other families who are unable to attend have asked us for the recording. Our comments today will be approximately 20 minutes long, leaving us plenty of time to take questions from everyone on the call today. If questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and you can use the icon with the hand to raise your hand and we can go over the questions at the end. We want to remind you that your questions are important to us and that we will do our best to get to your questions at the end of the prepared comments. And one last final note is to please remember to stay on mute so that there's no background noises during the presentation. With that said, let me turn the presentation over to Matt Daly and Stephen Abernathy, who will provide today's commentary.
Welcome, everyone. I'm Stephen Abernathy, and this is the February 2025 First Friday meeting and all of the recordings. Just to remind you, they're all available on our YouTube channel and on our website. And this is exclusively for the Abernathy Group family office members. As an aside, if you haven't been to our website lately, I want to send you just a quick invitation to please consider visiting. There's a wealth of information, and we add frequently to the information some of the papers that we write and some of the publications that are published widely. And there are some pretty clever estate planning ideas you might consider to help you at tax time, which is rapidly approaching. Also, we recently started a new company that's focused on reducing the cost of offering employees a corporate 401k plan while kind of keeping our eyes on the offering for each employee to get great education and the need for intelligent decisions about their future. Our goal really is to turn the staid and boring 401k plan from a cost center into a benefit that will, both increase employee retention and help employers recruit new employees. The point of my telling you this again is that Matt's been doing a ton of research for us, and we recently published a paper or a study that of over 700,000 corporate retirement plans throughout the United States, and what we found was that over 80% of those plans had legal red flags associated with their 401k plan structure, which is really sort of an indictment of corporate America. Setting up a 401k plan and just setting it and forgetting it. So if you have a few minutes and if you have a retirement plan, give me a call or stop by our website and read one of the research papers published recently. We really are happy to let you know how your plan ranks relative to the other firms your company competes against. Doesn't cost a penny. Just we're funded by the family office, and we hope that is helpful to you. Okay, so as Kim said, this month we want to discuss intelligent investment themes for 2025, and we want to do this with one eye solidly on the fact that our subset of investment possibilities may very well be overvalued and may be incredibly overvalued. So keep in mind that valuation is always the first principle of investing for us. And I guess it may be that we avoid investments that have promise during at times because the overvaluation represents just too much risk for us. So the investment environment today offers both, as you'll see in the slide ahead, that it offers a labyrinth of alternatives. Almost every investor we speak with is wondering which way to lean. You know, where do I go from here? The economy seems to be on solid footing, and we agree. Assets are expensive. Yep, they sure are. Are they more risky than they have been in the last 100 years? Again, I think the answer is yes. I know the answer is yes. So for us, it's a very tricky balancing act of finding assets that are fairly valued or cheap and have solid balance sheets with intelligent management and management that's honest enough to return capital to shareholders over time. So before we begin to allocate capital, it's a very good idea to understand the investment environment in which we are entering. So this is where our themes-based investment approach may offer we hope offers a helping hand. Today, we're going to cover the investment environment in general and do our best to let you know what the US and global markets are telling us about their expectations for the future. Next, we'll discuss a few intelligent investment themes, which we believe have unarguable promise. Keep in mind that with the new administration, the economic environment can change and is changing rapidly. This means every investor needs to be able to understand the impacts of the changes being made, not just suggested now. Keep in mind, there's a big difference between suggesting and actual change. And to spend some time understanding the second and third order effects of the changes, as those second and third order effects will take time to manifest themselves, thus offering true value for value or intelligent investors. We'll discuss the private equity and debt markets as they become so large today that they must have a seat at the table for every investor's decision making. And we're going to spend a few minutes discussing the US and global economy with a disclaimer that the new administration offers both US and global, both the US and the global economy an almost 180-degree change. It's clear that we're destined to lead, not follow, over the course of the next 4 years. And I'm not trying to make a political statement. I'm just saying that things are different now. And then lastly, we're going to discuss the stock market with some fairly obvious and welcoming data, and then address the world of artificial intelligence and how its second and third order effects might offer investment opportunities which remain underappreciated by the broad market. So today, all empirical evidence suggests that the broad US and global markets tend to be right more often than wrong. So what are the markets telling us today? And aside from the basic common sense, how does an investor determine whether the macroeconomic investment framework is welcoming? There really are several time-tested methods that are easy to use and tend to offer reliable insights into true expectations for future returns. However, it's important to note that these reliable and time-tested indications of expected returns are not timing indicators. They're not going to tell you when to get in and when to get out. That's not their goal. Their timing is to tell you about risk and expected returns in the future. So one of the best predictors of future returns is defined by the current price of assets relative to their current earnings. So, many of you have heard me say this a million times, and maybe you're tired of hearing me say it, but it's important to do this again. So it turns out that the current value of the stock and bond markets tells us a lot about what investors should expect for future returns. Unfortunately, empirical evidence tells us most investors, they just ignore this data and instead follow the talking heads and the press. In 2013, Robert Shiller received the Nobel Award in economics for data clearly displayed in this next slide. In short, what the slide says is the current valuation of markets tell us little about the returns which should be expected, and it tells us a lot about the expected returns over the course of the next 10 years. In this slide on the left, let me take this back. In this slide on the left, you'll see that each diagonal point represents a 12-month return from each month's closing price since 1968 based on the next 12 months expected earnings. So what it's doing is it's taking the current price and the expected earnings, and it's taking that today, each month, at the end of each month, and projecting it forward 12 months and seeing what really happened. And as you can see, the correlation is low to very low. And the current green shaded vertical bar tells you where we are today in valuation. As you can see, there's little or no correlation between the current valuation based on the expected predicted earnings and the stock market's value over the next 12 months. However, understanding that there's little to no correlation between the values and the future next 12 months returns, the current value of the stock market, represented again in the green bar, gives most observers very little confidence that a bright future lies ahead. For a better view of what lies ahead, you might take a look at the graph on the right-hand side. This chart takes the current monthly price. It's the same chart, but it projects the valuation, or it shows you what the valuation turns out to be 10 years hence. This chart offers an incredible correlation between current prices and the valuations investors should expect in the next 10 years. And the reason I'm putting this chart here for each of you is that each presentation over the course of the last 12 presentations, we've had charts that try to show the correlation between today's prices and the outcome 10 years from today. And each of the charts hasn't been very well received because I get a lot of questions going, why do you still think valuations are as high as they are? The chart on the right, let me just talk to you just for a second about how to read the chart on the right. The multiple of current earnings is on the horizontal axis. So that's the axis that describes the value. As you move to the right, you increase in value, and as you move to the left, you decrease in value. And as you can see, the lower the prices paid for assets, the higher the returns are that are received over the next 10 years. The correlation is absolutely undeniable, and it's for this reason that we've been outspoken about the need for intelligent investors to please notice this and expect little or no appreciation from current valuation levels. As again, the green vertical bar again shows us where we are in current valuations. It's just not a good picture. So from current valuation levels, investors should expect returns in the low single digits or negative returns over the next 10 years. This is why we shifted portfolios to higher quality companies with high dividends and a history of growing dividends to keep us up with inflation. In short, the market can continue increasing in value, yet it would certainly defy the odds of history. On the other hand, owning a portfolio of high quality companies with a dividend income of 5% plus, it just gives us a highly reliable and growing return, which meets most investors' needs. And it keeps us ahead of inflation, which protects purchasing power. I know that was a long monologue, and I'm sorry to get on that skid again, but let me check with Kim and or Matt to see if there are any comments or questions that have come up so far. Nothing, Kim?
Nope, nothing.
Okay. Matt, any comment on, or I know that maybe that wasn't terribly clear, but I'm hoping the correlation is evident.
No, it was clear. I think, not getting ahead of ourselves here because we'll get to it, but I think, not being overly optimistic or overly negative at this point is one of the themes here. So
yeah,
we'll go on to the next.
Okay. So let's hustle over to some of the themes we listed as worthy of consideration over the next year, and let's tackle the private markets first. So, private equity market is priced so highly that it would be difficult or impossible to determine future expectations. As many of you know, in the private equity markets, just over time, 5 or 6 of the 10 companies that you invest in either will blow up or lose value over the next 10 years. 2 to 3 of the companies make their money back and hopefully stay in business. And 1 or 2 companies deliver a 10x or more return. That's just the history of the private equity market. These are new young companies solving problems, growing helter-skelter, and sometimes they exist and sometimes they don't. It's almost impossible to know which companies will survive and which companies won't before the 10-year holding period ends. However, what we do know is that the period of 2009 to 2021 offered an interest rate environment of nearly 0%. And the private equity market and the private debt markets benefited from this in a huge way. I mean, in a significant way. It was an incredible benefit. Unfortunately, that period provided investors with expectations which are unlikely to be met with a comfortable outcome. In short, the higher prices of 2009 to 2021 will more likely than not be met with lower future returns, as logic and data would predict. What can we count on? Here's what we can count on. What we can almost guarantee is that fees charged by the private equity firms will decrease the returns investors receive even further. And for those of you who are not, for those of you who are largely fee insensitive, we would offer the following third grade math or pedestrian math. In 2009 to 2021, it was common for private equity firms to charge 1.5 to 2.5% or more in management fees. It became so commonplace that most investors agreed the math surrounding those fees was, we don't have to worry about it much. However, let me just take a moment to remind each of us that these funds take 10 years or more for your money to mature. 10 years at 1.5% per year means the investor is going to lose 15% of the investor's investment. Doesn't say anything about the return. It just means that I can guarantee you you're going to lose 15% of your money. And of course, a 2.5% management fee, which we've seen many funds invest in, and which our firm has one or two investments in it itself. It means that regardless of the returns we're going to receive over the following 10 years, we are guaranteed to lose 25% of our investment. That's pretty significant. At some point in the future, this will change as speculative furor declines. Yet, I don't want anybody to forget about the liquidity of a PE investment. When was the last time that you had the ability to see into the future with a reliable 10-year outlook? Some of these expectations are just ridiculous. It doesn't mean that investing in public or in private equity, it doesn't mean that you shouldn't be doing it. It means that you should be very selective about the general partners that foresee the future and that invest on your behalf. We will leave you with one final thought culminating into one question. Both private equity and private debt are incredibly highly priced. Both have high fees associated with their investment terms. Both have illiquidity measured in decades, not in months or years, and without dividends or current cash flow. What could possibly go wrong? So, Kim and Matt, any questions or comments so far?
No questions in the chat.
Gotcha. Okay. The theme that here that most investors must embrace is that economically change is afoot. The new administration is determined to reduce thoughtless spending and return to what many believe to be common sense policies. As said, the relevant theme to embrace, I'm hoping, is that change is going to be constant over the next 12 months or more to come. I think intelligent investors should expect disruption. I think some of this disruption is going to be good. Some of it is likely to be bad, as you know, nobody's perfect. And Matt, I believe you have some relevant commentary on this matter. So let me turn it over to you and to see if there's a couple of thoughts you want to share with us.
Yeah, thanks, Stephen. I think it's definitely relevant. So one of the top things on everyone's mind is, I think, obviously the new federal administration, just a couple of weeks in, and the breakneck speed they're implementing their agenda. So the key syllable there, I think, is break. I think it's fair to say that the strategy seems to be to move quickly and break things. The number of new ideas flowing out of the federal government is pretty difficult to keep up with. And let me pause there because I don't think I've ever used new ideas in federal government in the same sentence before. But I think the takeaway should be a continuation of our cautionary sentiment from last month's First Friday in January, which is to say that these things could have positive or negative effects in the short and long term. And I think that's the overarching theme, which will be uncertainty, which we mentioned last month as well. So how do we manage that uncertainty? I think we stick to our core principles of investing in value and especially emphasizing a long-term view. I know that tariffs have been a big headline grabber. We talked about it last month as well. And one of the fixations of both, supporters and skeptics of the tactic, as well as the media, tariffs should largely be seen as a tool for leverage in negotiations, I think. most tariff threats are unlikely to ever be implemented. The United States, to draw the comparison, is like Walmart. In 95% of countries in the world, at least, are more like Randall's Country Market in Biloxi, Mississippi. That is only to say that we have all the power and all the leverage. Just because we have been reluctant to use it for the last 15, maybe 20 years, maybe more, does not mean that we don't have that position. Tariff threats on Mexico, Canada, and Colombia, some of the ones we've seen in the first couple of weeks, have already yielded concessions. We've threatened against China as well. China is a completely different story. Concessions will have to be made on both sides. And in that sense, tariffs may be used less as a tactic to bend the will of the other side, which we've seen with those previous mentioned countries, but more as an invitation to the negotiating table between adversaries who happen to also be trade partners. The primary risk, I think, to remember is that when you use the threat of tariffs as leverage, you must also be prepared to implement them. That's where the risk lays. And the possibility that they will go into effect is always non-zero. And I think we have to measure our risk accordingly. We have spent a decent amount of time in the past months discussing conflict. So I just want to briefly touch on that. I think it's fair to say that temperatures, at least on the surface, seem to be cooling. And if World War III were a 50-50 toss-up when we met last month, I think it's reasonable to say that the dial has shifted slightly in favor of avoidance. Although with international relations and conflict, these events can always turn on a dime. So it's important to remember. Lastly, a word of advice on international markets that could be lower risk environments. We have an administration, pretty unique situation that was already in office 4 years ago. So we know who the friends are and we know who the non-friends are. Western Europe, I think, does not like Trump, but they are America's, essentially America's bear cubs, and they would perish without Mama Bear to provide and protect them. They're friends that are kind of beholden to us. They really don't have another option. We're ideologically aligned. We're longtime friends. There's long-time relationships, but they can counter us and say things, but at the end of the day, they really don't have a choice. So I think Western Europe is not a major concern. On the other hand, several countries that were at odds with the previous administration are, pretty good friends, at least a few years ago, with the current one, namely Hungary, Poland, Israel, Saudi Arabia, and India. India in 2025, I think, is more like China in 2005. So that's one to watch for, especially, I think. If not, at the very least, for its potential, then for its proximity to China and the strategic nature of that relationship. Saudi Arabia is going through an economic revolution as an already very rich country. A lot of development going on there. They are also the linchpin that will make or break our relations in the Middle East. So that they also have leverage on the other side. All in all, these countries are more likely than others to be safer investment environments, potentially, over the next 4 years than many others that are a little bit more uncertain. I'll finish by saying that overall, there's a higher risk of short-term volatility due to rash actions, threats, less thought out words, and leverage negotiating tactics. However, in taking a long-term view, I think there's a possibility that government spending, regulatory cuts, an emphasis on utilizing American strength globally, and a proactive approach to strategic global relationships could put the economy on a long-term track of greater stability in a world that's frankly, changing very rapidly, not only because of technology, but also just relationships and rapid activity that's kind of, just unreasonable even to keep up with. But whether we go up or down from here, I think it's safe to assume that the road will be bumpy. So it's important to consider the risks, expect at the very least short-term volatility, and keep with the family office principle of investing in value and considering the long-term approach.
Matt, yeah, thanks, Matt. And I also want to make sure that I add, or I kind of glom onto what you're saying about things like the tariffs, and for everyone to think about the second and third order effects of what's going on. Don't forget, a tariff has a first order effect on our country. It also has a first order effect on the recipient of those tariffs and what happens to their employment markets. And so, and the reverberations hit us with a lag, but don't ignore the second and third order effects of these things. And so my point, I think, is I'm not trying to be nice to Matt Day. I'm just trying to say that what Matt says, I think, has a lot of gravity, and for people to listen to what actually happens and to give it some time, give it some time to evolve or to play out. I think we need to give this administration some time. I think we need to give them some latitude and let them do what the people voted them in to do, and to see how it turns out. Anyway, thanks, Matt. Let's discuss the stock market and the theme that's likely to offer investors slightly more return and definitely less risks, as the markets, as we've agreed, the markets are severely overvalued. So when the markets are overvalued and euphoria is high, speculative juices are flowing, it's almost always sensible to move towards value-based investing. We're value investors, and all of you know this, so that it may seem like we're just talking our book or talking about our preferred type of investing. You might say incentive dictates behavior, and it's driving our narrative. Yet statistics clearly demonstrate a support for this thesis. Here's a chart. It takes us back to 1927, and it clearly shows that value investing outperforms growth investing by about 4% per year over the last nearly 100 years. What it doesn't show is that value outperforms with a bit less risk. And I know that I sound like an old grandpa, but risk is what creates harm, and it really destroys capital. So, as most of you are most often buying companies with solid balance sheets, it's smart. And the closer you can stay to book value decreases your risk, because assets are worth book value. What you may also notice is that value investing has been underperforming for the past few years. And these periods of underperformance tend to produce periods of value investing outperforming or catching up over the years that follow. Here's a slide that also supports those comments. And this is, totally different. It's just from Bloomberg, and it's just data. The slide valuation levels relative to the last 15 years. This is how they've sort of related them. As you can see, almost every category of valuation, from price to book, from the pricing of junk bonds to equity prices, are at or near historical highs. This chart clearly shows that speculation's high, expectations are incredibly high, and that current pricing has little room for any disappointment at all. The theme that's dominated every topic related to economics over the last year has been artificial intelligence. And while I think we all agree that it's been misnamed, overused, and applied to anything and everything digital, there's some gravity and a lot of goodness that could come and will likely come from the machine learning and the combination of machine learning with large language models, which is really what most are calling artificial intelligence today. I'm not trying to be snarky. I'm just trying to say, artificial intelligence is to come, and I hope it will get here. But right now, we really have large language models applied to machine learning. Anyway, our point is that, as you probably know, everything associated with the first order effect of AI is priced to perfection, and many intelligent observers would support the statement that it's priced to significantly above perfection. However, we want to help each of you consider diving a bit deeper into the value chain as one or two levels below the surface. Those companies that are using AI to help make intelligent and more well-informed decisions are starting to produce incredible results. It's happening already. Here's some thoughts. Education. I know my wife is tired of hearing this, but for 10 years I've been telling her about the disintermediation that education is going to take as the let's just say that let's think about every young person having a tutor with the intellect of a PhD level teacher today at their disposal 24/7. I mean, just think about that. So when you start to apply that, having all that information, having access to all the information that's ever been created available to every young mind, the only limit becomes curiosity. It empowers civilization and it creates equality, limited by only access to a computer. And as said, curiosity becomes the limiting factor. Curiosity and effort. However, what effect does this have on our brick and mortar educational systems? So I guess what I'm trying to evince here is that there's a second and third order effect of all these things, and with some good, there comes bad. There may become bad. It looks like to me that over the next decade, the brick and mortar educational system is going to become stressed at best. There's a lot of conjecture that we will be employee constrained over the course of the next decade. I've heard everybody in the left-leaning New York complaining about immigration, deportees taking a toll on our employees, to the fact that we have demographics in the United States, in the majority of well-developed countries, declining. The conjecture that we will be employee constrained over the next decade due to falling demographics in the United States and many other countries, it's true. However, we're likely to be 3 to 5 years away from having robotics engaged in a significant amount of manual labor. So what we've been saying around our firm is be careful what you watch for, or be careful what you hope for. Robotics are coming. They're here in many instances, and they're going to become more prominent as time goes. Let me move real quickly to the healthcare and the pharmaceutical sector. Just for instance, they're tasked with a decision process that's described as, a lot of us have talked to this between each other as a one-to-many decision process. For instance, when a biotechnology company finds a molecule that has activity within the human body, yet there are over 100 or maybe 1,000 different receptors that may benefit by this activity. We've got to make a decision. Which of these receptors do we perform with a clinical process or clinical trial? And don't forget, these clinical trials take hundreds of millions to billions of dollars to take place. AI can help this decision process shrink from years to days of combinatorial processing. It's just what they do. So that's one sort of easy example, I hope, of understanding how one to many, any company or any industry that is constrained by a one to many decision process is going to be incredibly helped by AI. Another easy example is the energy market. It might be easier to understand. So the exploration and production of energy companies, maybe they have 10 to 50 different drill sites that they're trying to choose from. Which site is likely to give them the highest return on their investment? The decision may take months of calculations mixed with trial and error and lots of failure. Yet in the future, it's going to take a day or maybe even less than a day with a higher success rate and less pollution. AI can do that. And again, these are not pie in the sky. These are things that are in process right now. We have a degree of confidence. And I'll leave you with a thought about the next generation of clean energy production. Is it to be the domain of fusion or fission? So, of course, we don't know. Is it hydrogen or is it nuclear? We don't know yet. We have a high level of confidence that AI is going to help us make intelligent decisions, and it's destined to make our future brighter. Let's move on real quickly because we're getting long in the tooth here, and turn this back over to Matt a little bit for some geopolitical comments because things are changing, and it feels like to me things are changing for the better in a big way. Matt, do you have some comments on our geopolitical future?
I do. I think it's an approach of cautious optimism. I think returning to the hot conflict, at the very least, there's been some proposals. We have a ceasefire in Israel in that conflict. We have at the very least, Russia and Ukraine at least putting out some terms for or conditions for the end of that conflict. I think I saw the other day that Ukraine's conditions were a non-starter. I think that's probably true because those conditions were what kind of started it in the first place. But I think we have a fast pace coming on, and I think we have, regardless of what you think of the current administration or what any of us think, there's some smart people in there that have diversified viewpoints and are interested in de-escalating global conflict and increasing United States influence and kind of focusing on the best interests of our economy. Where that leads to in terms of allies and hopefully new friendships and what their economies do, a lot of uncertainty there. Hard to say, but I think at this point, after the last 3 years of especially these two major hot conflicts in Israel and Ukraine, I think there's a global interest in de-escalation. However, I think looking forward, the next hot topic there is going to be China and Taiwan. And I think there was a legislation introduced to end the one China policy that is potentially problematic. And that is honestly a potential catalyst to World War III, even more so than the two current ones. I hope the attitude of de-escalation continues because there's so many risks surrounding that. It would be, we need 2 more hours to go through them all. Um, but I hope and I think the sentiment is de-escalation, and I hope we continue on that path.
Me too. Good point, Matt. Kim, any topics or questions that have come across so far? Nothing?
No, nothing so far.
Okay. Matt, any last comments, or Kim, any last comments for everyone? Nothing?
None from
No,
me.
that's all I've
Good.
got.
Okay, guys. Thank you for tuning in. And please call us if there's any personal thoughts, or if there are any personal thoughts that are important. Give us a call. We'd love to hear from you. Onward and upward.